A sea of red in Asia today, with all indices falling across the board after Fed's chairman Jerome Powell significantly moved markets. He said the Fed is not confident it has done enough to bring inflation down and to get the policy in line with its 2% inflation goal. He stressed that the Fed can be cautious as the risks between doing too much and too little have come into closer balance, he said. Inflation peaked above 9% in June last year, but then in a series of 11 rate hikes that essentially constituted the most aggressive policy tightening since the early 1980s, the Fed took its benchmark rate from near zero to a target range of 5.25 to 5.5%. For more now, let's bring in Mike Ingram. He is Senior Market Strategist at Active Trades. Thank you very much for joining us. So Powell's language was quite hawkish yesterday. Do you think he is trying to signal hikes in the near term, or rather, is he simply trying to prevent that the market goes ahead of itself and start pricing cuts too soon?
Well, I think it's the latter. Certainly the Fed doesn't want to pre-commit on rates at this, I think, late stage in the interest rate cycle. However, they certainly were concerned about how Powell's speech post the FOMC last week was interpreted by the market. And I watched that presentation myself and thought, well, why is the market thinking this is dovish? If you looked at how the market was positioning on Friday and for much of this week, it was really all seen as downside risk in terms of interest rates and very little priced in the possibility of a rate hike. If we look at where, for instance, interest rate futures markets are positioned today, they're saying, well, the chance of a rate cut is probably down to about 40% now, and crucially, maybe a 10 to 15% chance of a rate hike at some point in the next few months. So I think that's what Powell was aiming for. He wants to see a little bit more of two-way risk in the market, because ultimately the Fed is confident that US economic growth remains resilient, inflationary pressure is still there, and basically they can take it.
Right, so Powell yesterday also suggested a review of the Fed policy framework beginning in 2024. What do you think this will mean in practice? And essentially, what effects will this have on markets next year?
Yeah, so the Federal Reserve conducts policy framework reviews every 5 years or so. In 2020, it adopted what it's called flexible average interest rate targeting, inflation targeting. So what that meant in practice, I think, was that rates were likely to be not terribly responsive to the sort of supply side shocks that were represented by COVID. So it was really bad timing for the Fed. Going forward to the next review, which, as you say, 2024, active probably in 2025, 26, is probably going to see a modification of that. It's probably going to mean that the Fed is going to be more reactive to those sort of same supply side shocks. So there's more volatility in rates. And it probably means that we're probably overall going to see somewhat higher rates than we otherwise would. So, I would say a bit more policy uncertainty going forward. And that itself is going to also attach a risk premium to markets generally.